Hello and welcome to this latest weekly market recap for the week ending Wednesday, August the 6th, 2025. I'm Tom Bowley, Chief Market Strategist at EarningsBeats.com, and it's a pleasure to be with all of you again this week. Well, it's been an interesting week. It's now been 1 week since the Fed came out with their announcement to keep rates unchanged. Fed Chief Powell also indicated that they had no intentions, at this point anyway, of cutting rates in September. The market sold off last Wednesday, if you recall. And then Thursday morning, we got the GDP number out for Q2, the initial estimate anyway, which was way above expectations, up 3%. And then Friday is when another shoe dropped on the market. The jobs report came in, and the problem was the July number was much less than expected. It was still positive, but much less than expected. But the real issue was the fact that jobs for the month of June and also for May were revised significantly lower, meaning that the resilient economy that the Fed's been talking about was not nearly as resilient as they had been saying. And immediately we started to see the 10-year Treasury yield put the brakes on. It was going up, put the brakes on, started coming back down, and that yield has been coming down most of the last week. That should lead to lower mortgage rates. I think eventually the Fed will cut. There are a lot of folks now beginning to think that the Fed may cut each of the next 3 meetings. But I don't put anything past Fed Chief Powell at this point. Let's see what they do at the next meeting. And we still have Jackson Hole coming up at the end of August. We'll have a speech from Fed Chief Powell before the next meeting in September. So still a lot of stuff to go through. We've got the historically bearish, or at least historically cautious period ahead of us. August, especially the second half of August and throughout the month of September, historically a rougher period for the market. That's a more challenging period. So we got a lot of things that we have to deal with, along with some technical issues after a big reversal last week. So we'll look at all that in just a minute. But first, let's go ahead and take a look at what happened over the course of the last week. Just a reminder, when I'm looking at the last week, I'm looking from last Wednesday's close to today's close. So I'm going Wednesday close to Wednesday close. Just want to make sure everyone understands that. Transportation stocks. Now, this is interesting because when the Fed came out with their announcement last Wednesday, the transports got clobbered to the downside. I think there were a lot of folks thinking, well, maybe we're probably not going to get a rate cut, but maybe the Fed starts talking about a possible rate cut in September. When that didn't happen, transportation stocks sold off hard last Wednesday. So what's interesting is I see transports over the last 5 days now bouncing back, and actually the best performing index, which is kind of shocking. I didn't even know until I pulled this up that transports had actually led over the last 5 days. So anyway, we'll see whether or not the transports continue to move to the upside. If we see that, then I think it's a bet that the market is making that we are, in fact, going to see rate cuts coming. Anyhow, NASDAQ, S&P, Russell 2000, Dow, S&P 400, midcap, all lower over the course of last week. So transport's the only one showing strength there. Moving on to the sectors, it was interesting. This is an intraday, but let me give you a 1 week look to see what is leading. And you can see consumer staples on top, 1.43% gain over the course of last week. But we still had communication services, consumer discretionary, and technology in the 2, 4, and 5 spots for the week. So, the market was a little bit weak. We saw a rally back, but leadership, it's not like leadership is completely abandoning the aggressive groups and moving into defensive groups. That's normally what you see when the market is trying to put in a final top. And that's really not what we're seeing here. Even with some weakness last week, we're still seeing money rotating toward aggressive stocks. So if we pull back, and I still think that's an if, I mean, we're kind of in a period where if we're going to consolidate or if we're going to sell off, this would tend to be the time to do it after we get through earnings season. We still got, a couple more weeks of quite a few second tier kind of companies that'll be reporting. But once we get beyond that, most of earnings season will be over. And that's normally when the market settles down and pulls back. So again, I think we've got the next couple weeks where we might see a little bit of sideways consolidation. Maybe we go a little bit lower. I'll show you on the S&P 500 some levels I'm looking at in just a minute. But the under the surface signals are not really suggesting that we're going to have a big sell-off. So I think if we get 3 to 5% off of the recent high, that would probably be it. Maybe we go a little bit more than that, but I really wouldn't be looking for a whole lot more. Go back, let's look at the S&P 500. So the top that we saw came on Friday with that jobs report, or actually on Thursday. That was after Meta and Microsoft had reported Wednesday night, if you recall. So Thursday morning, we open up and then we sold off all day long on Thursday. And then the week jobs report came out on Friday, a gap down, we sold off again. So we had 2 days of pretty heavy selling. Look at the volume. Over the last 5 days, the volume was heaviest on that Thursday and Friday of last week. Volume has been much lighter this week as we've tried to rebound. So I think this potentially, and knowing the history of the market, a lot of times we'll see some summertime tops that come in during the months of either July or August, maybe even September. So I think we got to be careful given that bearish engulfing candle occurred on heavy volume after some great news had come out on both Microsoft and Meta platforms. And then we got the jobs report that took us down even further. I think the level to watch to the downside, at least initially, is 61.44. That was the level we had set as the all-time high close back in February before we had the pullback, before we had this quick little cyclical bear market. So 61.44, once we broke above that, that becomes price support. So that's a level to watch. And then notice the 50-day moving average right now is sitting at 61.59. So you got a couple of key levels, the 50-day moving average and price support within 15 points of one another. So that's a level I would watch here over the next few weeks if we do see a bit more selling before what I think will be an end-of-year rally. I also wanted to show you this S&P 500 chart. This is 5 years. It's a daily chart. But what I wanted to show you was the healthcare, all the defensive groups, essentially. Look at where we were when we topped going into 2022. Because a lot of folks say, well, we're going to have another bear market like we had in 2022. That's going to last a lot longer, blah, blah, blah. And normally the market will set up in a certain way. We'll start to see rotation out of aggressive groups and into defensive groups. And if you look at this last high that was set at the beginning of 2022, notice that the relative low on healthcare came in the month of November. So we were already seeing rotation into the defensive healthcare group at the end of 2021. Notice staples. Again, we had a relative low in November. So money was starting to rotate into staples before we topped. How about real estate? Well, real estate had topped earlier, but you can see in the month of November and December, we were rallying on a relative basis in real estate. How about utilities? Beginning of November is when we had bottomed on a relative basis. So do you see the last couple months before we topped how money was rotating into defensive groups? That means that it was rotating away from offensive groups or aggressive groups. That's kind of what you look for before you want to think about a major top going in play. Now, I want you to look at where we are right now. So here we're making this big move up, and we just recently set a high at the end of July. Look at healthcare relative to the S&P 500. Money is still coming out of healthcare. How about staples? Been coming back down. We're near 5-year low on staples right now. How about real estate? We're at a 5-year relative low on real estate. The only defensive group that's showing any strength whatsoever is utilities. And if you look at the seasonality, utilities actually likes the months of August and September. So this is kind of a normal thing. When August and September, we tend to see a little weakness in the market. We tend to see some rotation into utilities. And so that might just be some of the seasonality there. But my point is, we're not seeing money rotating into defensive areas. Wall Street is not positioning for a big decline. If Wall Street's not positioning for a big decline, I can tell you right now, I'm not going to. So keep all this in mind as you consider your trading strategy over the next couple of weeks, couple months, and into year end. So I'm thinking that we might top and we might consolidate for a bit, but I'm not looking for a big sell-off. And that's one big reason why. So here's the XLY versus the S&P 500 going back the last 2 decades, 20 years. Notice the odds of the XLY outperforming the spider goes up from the June low all the way through July, August, and September. So as we work our way through the rest of the summer, the odds of discretionary outperforming staples is pretty strong. So I think with that, I wanted to show you some areas within the consumer discretionary area that I think are worth checking out right now. First one is specialty retail. You can see specialty retail breaking today back above its 20-day moving average. So that's the first one I wanted to show you. Another one, this has been a really weak area, but there's a positive divergence. And look at today's break above the 20-day moving average. That break above the 20-day, you can see right here. Look at the PPO going up with the final lows in price going down. So price going down, momentum starting to turn back to the upside. This doesn't mean bullish momentum. It means less bearish momentum. You don't really start thinking bullish momentum until you get above the zero line. So what this is saying is that the bearish momentum was slowing when price action kept going lower. That normally, not always, but normally will lead to some short-term strength. And once you get through the 20-day, I look for a 50-day test. I look for a centerline test. So this, I'm not trying to say this is a great group. I'm saying this is a group I could see maybe rebounding in the near term. Next up, home improvements. Big breakout here on home improvements, taking out the reaction high from back in May. I think this is a strong group to consider. I've been talking for a while about home construction, home builders. They continue to strengthen. They bottomed all the way back in that April low, and they've been strengthening ever since, now trending up above the 20-day, which is above the 50-day. So home builders continuing to look strong. And then furnishings, another area that I think has really picked up in recent weeks, even in the last month and a half, clearing these tops that we saw from over the course of the last year. Now every time we go down and go below that 20-day moving average, the last two times we printed hammers, come right back up. We've held the 20-day, and then we've shot higher off of that. So it looks like furnishings also performing pretty well. So those are just some of the areas maybe to be thinking about as we look toward the rest of August and into September. These are some areas that maybe you could trade in and out of. I'm going to be much more nimble, I'll be honest, until the market, if we can get another breakout on our major indices, that would be great. Until then, I think I'm just going to be looking, I'm lowering my bar of expectations on the market. So I've been very bullish since the April low, as anybody who's been watching the show knows. I'm starting to just ratchet that down just a little bit. I'm not bearish. I'm just a little short-term cautious. And we'll see what happens. Market may just keep going higher. I wouldn't rule that out for sure. Anyway, if you are a fan of EarningsBeats, if you're a fan of the show, go over to EarningsBeats.com. You can scroll down. We have a free newsletter. Name and email address is all it takes there. No credit card required. You can join literally tens of thousands of folks that have joined our free newsletter. We do a lot of educational pieces in there. And it's an article that comes out twice a week. So anyway, make sure you check that out. This Saturday, though, this is what I really want you to focus on. This Saturday, we have an event, Invest Confidently, 2 steps to better stock picks. If you click on that, it'll bring you to this landing page, name and an email address. This is a completely free event that we're going to have on Saturday at 10 a.m. Eastern, but you do need to register for it. Even if you cannot attend on Saturday, register, because we will send you a copy of the recording if you're registered. So make sure you sign up. If you're on your mobile device, there's an area on your screen right now with a QR code. Simply scan that, and you can go into a landing page on your mobile device and sign up there, trying to make it as easy as possible. And I hope we're going to see you on Saturday. I want to give you a little bit more information on this. What I'm essentially going to do in this presentation is show you the process that we go through to put together our portfolios that we hold for 90 days. I want you to check out the performance. Now, this was as of Tuesday's close, Tuesday, August 5th. I can tell you today, Wednesday, August 6th, we actually outperformed again. So the numbers would only be better. But this is as of Tuesday's close. And over the course of our last quarter, which for us is May 19th, August 19th, so we're almost to the end of this quarter, The aggressive portfolio is up 24.5%, and the S&P 500 is up 5%. We're up almost 20 percentage points higher than the S&P 500. Our model portfolio is up 10%, which is almost double the S&P 500. And if you look since inception, the model portfolio we started back in November of 2018, right in the middle of a cyclical bear market, by the way. That was the trade war with China, if you recall. We started it right as the market was going down, and we've had 3 more bear markets since then, by the way. So it's been a pretty rough period. And our model portfolio is up 318.77%. The S&P during the same time frame, up 134%. We have not only outperformed the S&P 500, we've more than doubled it. We're up 2.4 times the S&P 500 over a 7-year period. There aren't too many folks that have that kind of track record. Our aggressive portfolio, which we started a year later, since inception now is up 211%. The S&P is up 120%. So we've got a long-term track record of being able to pick stocks to beat the S&P 500, and we want to show you how on Saturday at 10 a.m. So I don't usually give out our picks that are in our portfolios, but I thought, okay, our aggressive portfolio is up 20 percentage points above the S&P 500, and we're going to be switching them out in 2 weeks anyway. So I'm sharing the stocks with you. This is today's performance of all of our stocks that are in our portfolio, aggressive portfolio. And down here, you'll see the S&P 500's included just for reference. So you can see how the stocks perform relative to the S&P. We've now got Roblox up 5.5% today, UTI up 4.6, GEV 2.28, HWM 1.53, Celestica CLS up another 1%. 6 of our stocks today outperforming the S&P 500, 5 underperforming the S&P 500. And we've been doing this now for almost 3 months. I want to show you the returns if we just go back 3 months. CLS is up over 100% in the last 3 months. Roblox is up 90%. GEV 66%. NVIDIA 58%. I mean, the S&P over the same time frame is up 13%. So you can see the overwhelming majority of our stocks crushing the S&P 500. The one stock that's really done poorly, Duolingo, which is in the software space, actually reported after hours tonight. Let me show you what they're doing after hours, because this is certainly going to help us tomorrow. Duolingo is up $52 after hours, up 15%. So some of the underperformance there is going to get reversed tomorrow. You can see the stock has been going down. Mostly what we try to do is look for leading stocks and leading industry groups when we put these stocks in. And then we just hope that 2 or 3, will continue to perform well so that we can outperform the S&P. In this case, we've had a whole lot more than that. We've had, like I said, 6, 7 that have absolutely crushed the S&P 500. And that's how you beat the S&P 500 by 20 percentage points. Also after hours, I wanted to mention DoorDash. This is not in our portfolio, but it might be in the next one. Great earnings report out of DoorDash after the bell. You can see the stock now up $19, 7.5%. Giving you a couple of others. I can tell you this DoorDash, if you look at the stock, look at the AD line. Super. Price action, awesome. Relative strength, almost perfect. And then look at the internet group relative to the S&P 500. So DoorDash is kind of like a poster child for getting a leading stock in a leading industry group. And you saw what happened when it went into earnings. Now, we had a session earlier with our members, and one of the stocks that I looked at that reported tonight that I didn't like was Airbnb. So Airbnb, the AD line's pretty good, but it's really been struggling over the last few months. And look at Airbnb relative to its travel and tourism peers. It's near a 52-week low. So in other words, Wall Street goes out, talks to Airbnb's management, then goes out to other travel and tourism companies, talks to their management, and they decide, you know what? We want to sell Airbnb and we want to buy some of these others. So Airbnb becomes a laggard in the group. And then after hours tonight, Airbnb reported earnings and it's down 7% after hours. I mean, unfortunately, this is the way the market works. And if you don't understand how it works, it's really difficult to beat the S&P 500. So there's some great companies out there. I'm going to go through a couple real quick stocks that might be on our list for the next quarter in our portfolios. I don't know. This is a software company, DOMO, DOMO. Let me pull it up down here on this chart style. AD line, great. Relative strength going through the roof. And of course, software has been strong. So that's one to consider. How about Broadcom in the semiconductor space? Great AD line, price action great, relative strength has been strong. And of course, semis have been on fire. How about Oracle? Oracle AD line strong, price action up. A leader in software. And of course, like I said, software doing well. And then let me give you one more here. This is in the AI space. Vertiv Holdings, VRT, AD line great, price action super. Relative strength has been picking up for the last 4 months. And like I said, it's in that AI, DJUSAI group, which has been outperforming the S&P 500. So these are the types of stocks that we want to be looking at. We're going to talk about this a lot more on Saturday. So I hope you're available, and I hope you can join me on Saturday. Would love to see you. That's it for me, though. I'll be back next week. We'll check it all out again. Let's see what the market does over the course of the next 5 days. For now, I think we're in a trading range until we either break out above the high last Thursday's open or the low that we saw on Friday's close. For now, we're just trading in that range. Have a great rest of your week, everybody, and I'll see you next Wednesday. Happy trading.